Welcome to the third day of the Emerging Markets Conference. It's always exciting to get to the last day. We are starting with a panel discussion on stablecoins and financial market stability. And Yesha, you're the moderator, and I think that we've got an hour of discussions. As with all the other panels, we have a presentation that we start with, which sets the context, and we have a set of panel members. But now I'm going to hand it over to Yesha. By the way, this is a self-regulatory conference in the sense that the moderator does timekeeping for the panel. And Yesha, so it's now all in your hands. Floor is yours.
Thank you, Susan. Thank you for kicking us off today with this panel on stablecoins. I don't need to tell any of us in this room how topical, important, controversial, exciting this topic is. And we have a tremendous panel today with a range of expertise and jurisdictional coverage to inform us about the debates. Critically, I think it's worth noting that the question of stablecoins is sitting along a spectrum of discussion that will also include central bank digital currencies, which are being debated across the world, including in India, obviously. In addition, there's a lot of discussion about how the structure of stablecoins relates to known ideas and concepts in relation to shadow banking, capital regulation, central bank oversight of liabilities within the financial system. So these are all topics that we are familiar with from our knowledge of the financial system, but they're appearing in new guises through this concept of the tokenization and the issuance of these stable coins by a range of actors within the financial markets today. So without further ado, I would like to invite for our kickoff presentation, Dr. Manmohan Singh, who is a senior economist at the IMF. He really needs no introduction. He is a formidable scholar and one whose writings in relation to repo market, shadow banking have become seminal, I think it's fair to say. He is relied upon by regulators, market participants for his thoughts. He is by far one of the nerdiest people I've ever met in this area. I think possibly the nerdiest. And you'll see why in just a minute. So I think with that, Manmohan, if you can kick off with your presentation, and that will give us a chance to set the scene for our conversation.
Thank you, Yesha, and good morning, everyone, or good middle of the night to some. Okay, I'm going to have 9 slides. I promise to wrap it up in 15, 16 minutes so that we can have a decent panel. I will touch many topics, which are related, and hopefully we'll have time for Q&A because that's where I really learn. So here we go. I think the punchline of this paper is that if you see my bias towards stable coins, and my argument is both banks and non-banks will need to be interoperable, and I will define these terms to make a real difference in this new landscape. There's almost every second, third email is about payments and settlement. But if you're just putting old wine in new bottle, there's nothing new. So let me give you a couple of speeches. I know people don't read speeches, but these 2 speeches were both made a few hours apart. If you have time, if nothing else, try to read these 2 speeches because it gives you a very strong flavor from both the US.
Manmohan, are you going to share your slides onto the screen?
Yes, my slides should be on.
No, they're not on.
They're not on, Manmohan. You have to share the screen.
Okay, I actually made sure I was. Okay, hold on. Is Rakesh there?
Yeah, I'm here.
Rakesh, what happened? I thought this was already on screen. 1 second. Is there something I need to do to bring it on screen?
Yeah, yes. You need to share your presentation.
Just press share screen at the bottom.
I don't see the bottom. This is full screen right now.
So it says security participants chat share screen.
Okay, hold on. I did not want to waste time on this.
Don't worry. It's totally fine.
Okay, share screen. Okay.
Yep, share screen and just pull up the presentation.
Yeah. And I'm going to go.
Yeah, Manmohan, we usually give 10 minutes extra to all panels without telling them.
I came 30 minutes earlier to make sure I get this correct. Okay, hopefully
Okay,
I
here we
will
go.
not have to.
Here we go.
Okay, I'm glad Rakesh is here. Okay, so the point I'm trying to make is there are two speeches and they could not be more different. They were both given the same day, June 28th this year. And I have read it several times over, and I'm actually took out a few pieces for you to realize how different US is relative to maybe the UK BIS mindset. So Randy Qualls, who just resigned at the Fed, made a few remarks which basically said he's skeptical whether the Fed Reserve has the legal authority to pursue the CBDC models. Further goes on to say, if they are properly structured, the stable coins could well be, part and parcel. You don't need a CBDC. Remember, banking intermediation is not liked, and most of the banks here call the shots. Okay. He also argued the benefits of Fed CBDC. If you are reading the academic papers by Kumhoff and some by Ulrich Binsai, I'm also not very sure how much extra you can get if you can get something structured very much like CBDC under the rubric of stable coins. And he does believe in considerable risk because the counterparty out here is the Fed. And as we know, all central bank balance sheets are already very, very large. Do we need to make them another 2 times over? On the other hand, same day, early morning, Kadi gives this Andrew Crockett speech at Basel, where he said public should have access to central bank money. He goes on to say the native cryptocurrencies will be dominated by CBDCs, unless, of course, you can make stable coins very much similar to CBDC. He goes on to say that private stable coins would no longer be different than a CBDC. And then he again argues that you will have a two-tier system, cognizant that bank intermediation will be very, very difficult. All these models showing how you'll auction deposits from central bank backs to the bank, it's very topsy-turvy. It's all models. In real life, can you imagine JP Morgan bidding at an auction from the Fed to get deposits? Anyway, long story short, there's no consensus of CBDC. The DeFi world will have winners and losers. We don't know how far DM will go, what will happen to a Tether, but we do know there is some very good underlying economics for stable coins. And this speech, if there was an overlap, both agreed on stable coins. I would encourage you to read both these speeches. They are probably, 2-3 pages a piece. So it's very worthwhile. These are some charts from a recent GFSR. It's an IMF publication biannual. You'll see this market is around 2 trillion, the crypto market. But as I said, I'll just talk about stable coins because I believe there is interest and there's overlap and there's some economics. You can see what's happening with Bitcoin, etc. But this green area is what I'm going to talk about. This market, stablecoin, is about 130 billion. And in this 130 billion, you have a Tether calling half the shots. Then you have USD coin. You have another couple of coins, but you'll notice most of them are dollar-based. There's very little market outside the dollar. If I talk about the Fed or US dollar, it's only because there is vested interest in something backed by dollar or US Treasury or US commercial paper. Okay, let's go back. What's been going on with the good collateral market? I will also use the name HQLA, high quality liquid assets, for good collateral. I've been looking at this market for a very long time, even before Lehman. And if you realize pre-Lehman, there was a sizable market, both banks and non-banks would use this collateral in the market plumbing. There was very little central bank footprint. Basically, collateral was used, prime brokerage, sec lending, derivatives, repo, between non-banks, banks, they were always being used. So it's a very large market. By my estimates, about 10 trillion of pledged collateral was used globally, which was bigger than either M2 in the whole global, not global, but the M2 in US or the M2 in the Eurozone. Then, and you can see this in a paper by Fed, by a Carpenter et al. Most of these QA bonds were sold by non-banks. There's documentation that most of the QE was done when non-banks were selling the treasuries. This also makes sense because the dealer balance sheet, the inventory of treasuries or MBSs at the dealer balance sheet has been roughly the same. So most of this blow up in the Fed balance sheet is coming from non-banks selling to the Fed. Now, I'll bring this point later because what I call here is non-banks actually owned this good collateral. And now non-banks are not part of this new regime because this new collateral has turned into deposits. They got money, they stuck it at the banks, and the banks then take it to the central bank because you get a privileged rate, interest on excess reserves. So that QE money has ended up back to the central bank in the form of reserves. These are used interchangeably, and the numbers are north of 4 trillion, after a past decade. These numbers were 2030, there was no excess reserve. Reserves were about 20-30 billion with a B. Now you're looking at 4 trillion plus. So huge change in the central bank balance sheet, huge change from what non-banks owned, and now they have no say in deposits with the banks or what's called reserves. Now, I won't get into details, but basically, could we get that reuse? Remember, market lubrication, those bonds were reused. What can we do now that those bonds are gone, but we have deposits and reserves? There's nobody unwinding balance sheets. Bank of Japan has not. There's no timetable from the Fed. Tapering is not unwinding. Tapering is buying less bonds. They're still buying 105, maybe 90, maybe 75. They're still buying. Nobody's unwinding their balance sheets. But long story short, can we make better use of those large deposits in the banking system or reserves with the central bank, which are sitting ducks? Okay, and that's where I'm coming. Well, I'm coming from this background. I'll try to see where I can take this. The good collateral versus central bank reserves. If the stablecoin issuers can get central bank reserves, then you don't need to silo treasuries or gilts or bonds. Okay, this is an issue. For most stablecoin, I just showed the market for, say, Tether and Bitcoins and all. What's behind them? And in most models, even DM wants good collateral, which could be treasuries, which could be commercial paper. Something which is useful in plumbing is going to be siloed further. All this QE has siloed very good collateral. And if the fintech world doesn't come into the reg perimeter, we will silo more collateral and we'll produce. So these reserves in the central bank are not going to move. And there's enough of them that they should be moved. And in a T0 framework, central bank reserves are even more liquid than treasuries. This may take even 5-10 minutes to sort of complete the settlement, but reserves with central bank are instantaneous. And if your transaction is T0, you want reserves. You don't want treasury, although both are HQLA. So what's going on now? If you don't have access to central bank, you rent a bank. DM, Kraken are having accounts with Silvergate that allows them a central bank type privileges because this is a bank and this becomes your correspondent bank. So, although this acts as a custodial function, you start getting access to the central bank balance sheet through Silvergate. It's called renting a correspondent bank. Of course, you have to give a cut. What does Silvergate offer? Maybe it gets 10, 20, 30 bips from DM or Kraken. Kraken is a Wyoming special purpose narrow bank. DM, you all know, is a new name for Libra. Now, what I'm arguing is some fintechs genuinely want to come inside the reg perimeter. They don't want to give a cut to Silver Bank. They also realize they don't want to silo good collateral because if something goes wrong, even with the treasury market like March 2020, they will not be able to deliver on a T0 framework. There are applications with the Fed saying, please give us access to your master account. We don't want to be outside the reg perimeter, and we will follow all the checkboxes. Okay, and I'm saying this because there will be windows of time. For example, Eurozone, the bonds at the year end are at minus 700 bips. In other words, the policy rate is at 50 bips, and the repo market is so short of bonds that in order to settle, you might be paying minus 7%. So there are shortages of collateral here and there, and we don't want fintech to come in and silo more collateral because we are not unwinding central bank balance sheets. Does history have any lessons? I'll go fast now. Yes, for those of you who have looked at the Fed history, before the Fed came into existence in 1913, there used to be private check clearing banks, pirate banks who would clear checks. They'll take a cut, okay? Now that private bank had a network of their own, unlike some of the New England banks, which were formal banks, and they guaranteed at par. These banks did not guarantee at par, but they took a cut. And there was a paper after Lacker saying that the network effects of these private correspondent banks, the network effects were so strong that the cut they took or the margins they took were no more than the services they offered. In other words, that network effect was parallel and not sort of abusive of being outside the banking system relative to those inside the reg perimeter who were banks in the par clearing era. This is exactly something which could happen with the stablecoin market, that if fintechs indeed have network effects, if the DMs and Tether, they genuinely, or Bitcoin have some technology or platform like Ethereum, then they may be offering a unique technology which banks do not yet have. And this could be parallel where if they can be brought in, it's going to really make the banks move faster. If they don't move faster, you will see a change in the landscape. But if you believe that banks are ahead, which I don't think they are, then I guess everything will remain in the banking sector. But there is the numbers show us that the non-banks are leading here, not the banks. The banks want to keep the status quo. I'll go even faster now. If you look, if you think of all the deposits at the large bank, the JP, the Barclays, the Goldman Sachs, they may have stable coins which can be used reciprocally between each other. But you are getting a claim on the balance sheet of this bank, right? But we know they are GSIBs, they have the FDIC put, etc. Now, this type of market, which is to be clearing in T0 time, the amount what they have deposits under the stable coin, there should be no rehypothecation. That world should not be fungible with the daily liquidity type of operations, because indeed you want to be one-to-one backing. You don't want a tether out there. So clearly the big banks should be having a one-to-one backing with no leverage, which we don't know if that will be the case. Now, there are settlement differences between digital assets and traditional assets. The traditional business of GSIBs will be very different and is very different. The conventional banking with the digital banking. You and I can see it on a daily basis. Also, the digital assets won't have CCPs and clearinghouses, which you see in the conventional system. So it is a different world. And if nothing else, if this remains under the hands of the banks, at least their stable coins should be backed separately, sort of a ring-fenced, a ring-fenced way. Now, in parallel, there are fintechs who want direct bank charters to comply with the existing laws. Otherwise, how much ever HQLA they may back, even if Tether says I'm backing 120, 130, 140%, if you are not, under the Fed system, optically, you'll never be considered safe. That's why, a lot of the collateral behind the US stable coins gives you 4, 5, 6, 7% returns because they're not deemed to be stable or safe. Will banks and non-banks interoperate? When I say interoperate, in the true sense, I've never seen interoperate. There may be the Brazilian CCPs who truly interoperate, but in the derivative world, I've never seen interoperation. Here, I mean whether banks and non-banks. So if you have a client X should be indifferent to going to a non-bank or a bank. If a non-bank gives faster clearing, it should go towards a non-bank, but non-bank should be linked to the bank. Right now, most of the banks plan to link, but they have garden walled systems. They only link to each other. They're not permissionless, which is where the non-banks are. You don't need permission. They're open, and the non-banks have an advantage that you can hook onto them and sort of unhook, and that's up to you, and it's very quick. Most of the banking world have their own walled garden protocol. They don't want to interoperate with the non-banks, and this is an issue right now. For the non-banks to come in, the US banks have very strong lobbies, and they're holding on. The recent President's Working Group report also said that in order for you to issue stable coins, you should go get FDIC insurance. But think about it. If you're a narrow bank, you're 100% covered. There's no a Basel 8% capital, 100%. Maybe you can make it 110%. Should you need belts and suspenders? Why do you need FDIC when you are fully covered 1-to-1, or make it 1-to-1? There's even 1.1. They want everybody to become a conventional bank, which is not the case with many of the fintechs and non-banks who are being labeled as special purpose banks. So my last slide basically talks about there will always be a lender of last resort. The coins will be jurisdictional bound. So if something goes wrong with JP Morgan, it will be a headache for US. Something goes wrong with Barclays, it will be a headache for UK. Deutsche Bank will be a problem for Germany. Now, interoperability in the real sense means that technology takes you cross-border. So technology will sort of pull the economics, not the other way around, because economics will be bound by LOLR. Now, without central bank access, non-bank stablecoins will never be perceived to be as safe as the bank stablecoins, however large the HQLA buffer. Allowing stablecoins from banks and non-banks to interoperate can really change the dynamics. It may not be to the interest of the banks, but if non-banks get in and are inside the reg perimeter, I think even 1 or 2 jurisdictions allow it, it can change. There is inertia. There's a lot going on in the DC lobby circles, but so far non-banks have not been able to get any Fed charter. I think why I bring in US again, or the Fed, because 95 to 99% of these stable coins are dollar-based. That's not to say that you cannot have stable coins out of Singapore or say China or Switzerland, but the market so far has been US dollar market. I just had a question with someone just before this, and we can get into Q&A whether DM could issue stable coins, but they should not be backed by HQLA because there are limits to HQLA. Good collateral is not easily available, and if you use them, it's going to rush the market plumbing even further relative to reserves, which are plentiful everywhere. In almost all major jurisdictions, you have enough reserves right now because nobody's unwinding the central bank balance sheet. I'll stop here. I'll let the panel start, and happy to jump in the Q&A. Thank you.
Okay, so thank you so much, Manmohan, for that extremely insightful and very enriching presentation with a lot of content. So I want to, Manmohan, if you can stop sharing your screen, that'd be great.
I'm trying to get on. Yeah.
Okay, I mean, maybe I can do it as a host. Okay, so I wanted to open this up to the panel, and you know, the panel we have today is exceptional. We have Dr. Parth Shah, who is the head of public policy, School of Public Policy and Governance. He's an expert on free banking and the history of free banking. We have Professor Marco Dell'Erba from the University of Zurich, who is an expert on the European system and the Swiss system, and thinking about shadow banking and stablecoins and crypto. And of course, we have Bhargavi, Zaveri, who needs no introduction at all here, and who is a truly prolific researcher in the area of financial markets regulation. So I wanted to kick off from Manmohan's presentation and ask panelists, perhaps starting with Dr. Shah, what do you think about the inclusion of non-bank issuers within the perimeter, as Manmohan was suggesting? Do non-banks have a place here? Or in India, do you see stablecoin issuance as essentially being an inevitable function of the banking system, and that non-banks really have to play a secondary role or not be allowed to play any role at all?
From who oh, sorry.
Maybe we start with Dr. Shah, and then Marco, maybe you can continue with the shadow banking point. Yeah.
Thank you for having me on the program. My sense is that whether this would allow non-banks to issue stable coin or not would depend largely on the regulatory system that is going to come into force. So many of the points that Dr. Manmohan Singh made, all right, are dependent on what's the collateral, right? How the collateral is held, either in terms of treasuries or central bank reserves, right? So all of those parameters would play a role. My sense is that if the regulation is done rationally and which is conducive to more market participation, then I would suggest that non-bank would also be able to participate in this process. Just to sort of take you back in the example that was used about the pre-Federal Reserve and the so-called wildcat banking in the US during the Civil War, right? Before the Civil War and during that time. I think one of the key, that was the one time when we also had a convertible currency being issued. So the private banks were issuing banknotes, which were convertible into specie, right? And what happened, which is why it's called wildcat banking, that many of the private banks opened their main branches, main offices far away into the remote areas, right? Which is well, the wildcats play or roam. So that is why it was called wildcat banking. And my sense is that what happened there was that people could not convert their banknotes into specie on demand. They had to go travel long distances to be able to do that conversion. Right? And the solution to this problem also came from the same process of market evolution. Right? So Suffolk banking system around the same time came up in Massachusetts, and they created a clearing house where every bank had to maintain their own sort of reserves in the clearing house. And the clearing house indirectly became a regulator of the private banks in terms of the deposit requirements, reserve requirements, being able to clear the checks and liabilities on a daily basis. So I'm just referring to that old example to build the idea that convertible currencies, we have had experience with those, and the private sector has been able to manage that quite well. Similarly, in the Scottish banking system around the same time. And so there are historical examples of how we can rely far more on the private sector regulation, right, as opposed to state regulation, to be able to make the system work. Right? But I agree that specie, what is convertible into, the specie in a sense which is behind the stable coin, would have a lot of role to play in terms of what happens.
Marco, so building off of that, you've done a lot of work in shadow banking and the role of the private sector in the issuance of money and money-like instruments. What do you think about this? The issuance of stablecoins through the private sector. How comfortable are you with this concept, and what do you think will be needed to safeguard the regulatory perimeter here?
So yes, just let me add something on what Parth already said. I agree with him that this is not a new paradigm, and early central banks were basically private banks in which money value depended on the reserves, and this is what we are observing with stablecoins. Now, answering, and we've seen that the free banking era has definitely failed for some reasons. The problem of shadow banking enters here in two different ways. The way I frame stablecoins in the context of shadow banking is dual. I think about stablecoins in the context of what I call shadow central banking, that is by referring to a network of heterogeneous institutions that are adopting specific instruments, trying to disrupt the highest layer of the system that is the one of central banks. And then at the same time, looking at stablecoins as part of the crypto shadow banking, where the label crypto shadow banking really corresponds to the more traditional concept of shadow banking. So referring to a network of financial institutions implementing certain financial instruments, and looking at the causes of the establishment of this crypto shadow banking system, in which stablecoins certainly play a part that is similar to what money market funds do in the traditional system. There's a financial need, there's a problem of regulation, a problem of competition, and the problem of innovation. Why do I emphasize these ideas of shadow central banking and crypto shadow banking? because I find a similarity in the problem that all these arrangements create and cause. At the level of central banking, shadow central banking, there's a problem of risk of interconnections, clearly a problem of reserves, but also something related to the endogenous instability of these shadow central banking institutions. We all assume that Google and Facebook are stable, but there's a significant risk there, also technological risk that might make these institutions inherently unstable. And by looking at stable coins as part of the network of crypto shadow banking, there are the traditional problems related to leverage and opacity, liquidity risks, tech-related risks, and the problem of market infrastructures operating in this environment. So all I want to say is, yes, certainly non-banks will play a role, but we have to distinguish what kind of functions are they performing. If they are performing functions in the area of central banking or in the area of shadow banking, therefore trying to replace and invade the realm of central banks or the realm of shadow banks.
Bhargavi, what are your thoughts in this area, particularly coming from the Singaporean perspective now, where obviously Facebook is being courted and DM is being courted as a potential future stablecoin. So do you have any thoughts on the private sector involvement here and Manmohan's presentation?
Yeah. Thanks, Yesha. Thanks to the organizing committee for having me join this panel. It's a relatively, let's just say, evolving topic in India because we still don't know what the legal regime will look like. But leaving India aside, right, I wanted to pick up a little bit on what Marco said, and I wanted to take a step back and talk about the business models that stablecoin arrangements really follow, right? We know of two, there can be more, we already know of two, which is that you can have the tether model where each stablecoin is equivalent to one USD, right? So your USD tether, for every USD $1 that you deposit, what is the promise that is being made? The promise that is being made is that at any given point in time, you will, once you exchange one USD tether, you will get one USD dollar back, okay? So that's your classic, I was just reading the terms of the tether contract, and that said that 100% guarantee, redeemable at par on demand. What are you doing here? You're really actually doing something like a deposit function, right? Where you're taking fiat currency and you're giving tether coins. So that's one model that we know of already. Here, the claim is on the issuer and really the issuer's balance sheet. The second model that we know of is something like an ETF. And I keep drawing back to real world examples because they're just easier for me to understand. And that is where the tether coins actually give you a claim like a unit of a mutual fund to a portfolio, a basket of assets, right? So the claim is not on the issuer. The claim is that you will get something that represents a value of the entire portfolio of assets. So again, what is it backed by? It's backed by that basket and portfolio of assets that is kept with a custodian. So we know of these two models. Now, it seems to me that the first model, which is really in the nature of a deposit that is repayable on par, it's much more like a commercial bank model. And you could argue that actually you're doing pretty much what a bank does, and risks and activities that pose similar risks should be regulated similarly. And therefore, stablecoin arrangements that promise a one-to-one conversion on demand at par value should be treated like a bank. Now, who should be issuing these? There are banks which issue these. Can non-banks issue this? I mean, I don't see any reason why. It takes me back to the classic question, can we have more competition in banking, like in deposit taking? And it seems to me that yes, we can. But should these non-banks, or should they be regulated as full-fledged banks? I want to leave aside the question of access to, central bank payments, and I'll come to that in a bit. But it seems to me that this is not exactly like the classic fractional reserve banking, right? Why? Because with the reserves are actually that these stablecoin issuers like Tether Holdings actually keeps is a one-to-one conversion. It's not like it's the reserves are, you know, partly lent out in illiquid loans. They're actually liquid instruments. And in a market like India, I would argue that I don't know how liquid commercial paper is at any given point in time. I think Manmohan mentioned of an incident in April where treasury markets saw some issues and therefore they may not be liquid at a given point in time. But should you then regulate stablecoin arrangements that promise a one-to-one return as a full-fledged bank? I think that deserves some sort of thought on the details of it. But, you know, Yesha, I wanted to actually even come at this a little bit from the point that Parth mentioned, which is, you know, the idea of private banks actually issuing currency and then what happened. So yes, we are talking about 19th century here, we're talking about late 19th century, maybe early 20th century, where private banks used to issue its own private currency and the money was lent out, and we often saw bank runs, the classic bank runs. And then that gave rise to the question of what is the role of a commercial central bank? And at that time, there were no public goods central bank, right? These were commercial central bank. What is the role of the commercial central bank to provide the lender of last resort facility? So my worry with, you know, the main proposition that I think Manmohan is making here is that the moment you actually start treating these stablecoin issuers as banks, or you bring them within the regulatory parameter, the next demand is that therefore the central bank should, you know, provide LOLR, and then that in turn leads to more regulation, and then will we have the benefit of the costs of making currency transfers through stable coins, which is believed to be cheaper, although there's some data coming up which shows that stablecoin payments are not really as cheap as one would believe it to be. And you know what, where does it take us? And are we then asking for full-fledged banking regulation at some point in time? It's just a question I thought we should think about a little more.
So coming to the question of the private market, and you mentioned, Bhargavi, the two models. You know, I'd like to ask the panelists, how do we police the private entities that are currently purporting to hold these one-to-one correspondence between the coin and the assets? We had an incident, I believe, with Tether earlier in the year, where upon disclosing their balance sheets, it was found they were very far from being a one-to-one correspondence. In addition, Circle, I believe, revealed that instead of investing in super liquid assets, a part of their portfolio, portfolio was actually invested in less liquid assets. So, you know, the question that I want to sort of pose to the panelists, some of whom are lawyers, some of whom are economists, is how does the market regulate this issuance of private quote unquote money to monitor that the issuers are doing what they say they're doing? How do we do it from the market perspective, and how do you think we should approach it from the regulatory perspective to provide the mitigation against the financial stability concerns that are implicit in your discussions? I don't know who would like to kick off, but you know, thinking about that aspect of it. Manmohan, do you have any thoughts to kick us off, or and then we can go around the table?
Actually, yes. I just made some observation from the previous panel, and I wanted to clarify. You see, the growth in this market is so phenomenal that definitely these non-banks or fintechs have got value added. We cannot deny that. These numbers are growing. Okay, so there's something these guys are putting on the table which the banks are not putting. And the banks they love the intraday netting, they have the float, etc., etc. So let's be upfront. There is definitely the fintechs have something up their sleeves which the banks either don't have or don't want to have. Number one, in this world, if these guys are wanting to come to inside the reg perimeter, okay, should they, and many of them have a business model. I think I want to give you one example. A few years back, there was a bank called TNB, the Narrow Bank. But all it did was asking to do was arbitrage the interest on excess reserves. As a bank, you could get 25 bips and you would have clients and you might take 1 bip cut and give them 24 bips. But that was, the Fed basically said that's no business model. It's just arbitrage, and that would rush the plumbing. You could think about $1 trillion going to them, which could have gone to the market, but it doesn't. Now, there are now banks who are not empty models. There is a bank out of Wyoming which decided, I am a trust company. I have custodian. I'm a custodian. I hold crypto assets. There will be accounts which have positive and negative balances, and I want to move them to stable coins because I have a technology which will keep it at zero float. Okay. It says, I'm a narrow bank. Why do you want me to also get FDIC? I mean, either I'm a conventional bank or a narrow bank. Now, do you want to have a narrow bank? You can make them 110% a narrow bank. Should they also go for FDIC, which is in line with the bank which takes deposits and does loan, but a trust company who doesn't make deposits will never make a loan? Should they also go under the conventional FDIC route? That's one point and an example I wanted to make. And a small footnote over here. I think Ms. Bhargavi also mentioned this about a narrow bank, and whether the examples of ETF and money market funds. Look, the money market funds which are growing here are par value. So there's an implied put. The word par means they will be taken care of. So if you want to get the non-banks inside the reg perimeter, according to all the checks and balances, they need to, well, the word par will not be there, but the narrow bank concept means that they don't want to go through a correspondent bank. If they go through a correspondent bank, which is happening right now, DM, which is, which could be potentially large, has taken a cut from Silver Bank. There's another called a Tether. I believe Tether. Yeah, that's no, not Tether. It's a Kraken, also going through a Silver Bank. Do you want this type? Because these are just cuts. They're just renting a bank. I would rather you go through the full 9 yards with the Fed or a central bank, come inside the reg perimeter. Do not silo collateral. A point which is being forgotten here among the panelists is we have siloed so much good collateral that either you don't have debt ceiling constraints, you don't have any fiscal constraints, and you keep issuing debt. Otherwise, use the reserves. We got trillions coming out after QE. But this is another point. There is reserves to move. Let's move them. And then you bring in the non-bank concept. If they are legitimate, they have a business model, why not back it by reserves, which is plentiful, than to rush plumbing by siloing more collateral. Anyway, that's more than a few thoughts. Thank you.
Yesha, may I just come in here quickly?
Sure, go for it.
Okay, so, just a lot of things to unpack here, right? So the first question, which is that what is the value that stablecoins are bringing on the table that banks are not, right? So fortunately, we have some so the case that stablecoins makes for itself and, is that number one, cross-border payments will be cheaper, faster, more efficient with stablecoins. Okay, and number two, that financial inclusion, it makes the case for classic financial inclusion, where actually a lot of people are unbanked and stablecoins will help them get them within the parameter of some sort of a formal financial system. So let's just think about this a little bit, right? On December 14th, I think there was a Senate committee hearing where one of the witnesses actually gave a pretty interesting example of how he tried to transmit $200 from US to the EU using Western Union and using some of the stablecoin exchanges like Kraken, like Manmohan mentioned, and Binance, and a couple of those. And I pulled out the costs that he actually incurred for transferring $200 from US to the EU, okay? And it turns out that actually the Western Union transfer was much cheaper than the stablecoin transfer. So just, in case people are curious, the Western Union transfer charges for transferring $200 from the US to the EU is in the range of $5. And for stablecoin transfers, it was anywhere in the range of $6 to $66. I mean, it's staggering, right? Now, of course, this makes the case that actually, it bolsters Manmohan's case that if actually stablecoin issuers are given direct access to the central bank's payment rails, it may bring down the costs. Now, to what extent can it really bring down the costs? I mean, we have to figure that out a little bit, I think, leaving aside the collateral question and the siloing of collateral. The question is, what is the value add to the consumer from using stable coins, right? And the second thing I wanted to mention is, at least my understanding of central bank payment rails is that one of the greatest hurdles of using central bank payment rails is that actually cross-border payments are hard, even with using central bank payment rails. So the extent of benefit that one would get by giving access to stable coins to central bank payment rails in terms of payment transfer charges, I'm not too sure we still have a handle on that. And you could argue that actually you may be living in a world where a lot of people are using stable coins, a lot of merchants are using stable coins, and therefore these charges of, withdrawing the stable coins and converting into fiat, etc., will not apply. But I'm not sure if we are yet there, given that every jurisdiction is regulating these things very, very differently. So that was just one sort of point, which is that I'm trying to get a handle of what is the real value that stablecoin gets to the table, to the consumer. Payment charges, at least right now, it looks like huge difference between stablecoin payment charges, transfer charges, cross-border at least, and other payment mechanisms. The other thing is about FDIC, completely with Manmohan on this, right? Which is why I was mentioning that, okay, if you're giving stablecoin issuers access to the payment rails, then you're really talking about a possible LOLR function, a possible maybe intraday function, however small, intraday credit, however small. Suppose there is an operational breakdown, suppose there is a fork in the underlying code, etc. And then are we really then saying that therefore, we start regulating them as full-fledged banks? Because the moment you give access to payment rails, there is a chance that you're using central bank money, central bank credit. You're definitely using central bank money as a settlement asset, but are you then going to be using intraday credit? So those are just a couple of other questions that come to mind as we think about access to payment rails and, the specific use case of stablecoins when it comes to making cross-border payments. And financial inclusion, I mean, we all know that actually to be able to get access to these stable coins, you need access to a bank account to begin with. So I'm not too sure that the financial inclusion cause is also in its current form really served too well. So struggling with that a little bit here.
I doubt that we need LOLR function at all. Right? In the two examples which are given by Bhargavi, right? If there's a one-to-one match between stable coin and say the local fiat currency, could be USD or any other local currency, right? Then that's a 100% reserve system, right? So as long as you're able to guarantee that the claim of the stable coin that is convertible on demand into other reserve currency, right, on a one-on-one basis, then there is no need for anything else to regulate, right? Stable coin is holding 100% reserves. So as long as that is guaranteed, then there is no issue of bank run or any of those things that used to happen earlier or happens even now. Right?
But Parth, that's the thing, right? What is the quality of the underlying reserves, right? So if you see
USD, right? The underlying reserve is the USD.
So if you see Tether's, reserves, the breakdown of reserves, you find that actually 60% is in commercial paper, and maybe in the US, the commercial paper is a very
but that's a different issue in terms of whether they're holding one-on-one. What are they holding in the reserve? If they're going to be holding USD on a one-on-one basis, that's 100% reserve banking, right? And in that case, you would not have any need for LOLR function. There would not be possibility of a run because there's a one-to-one match. If the match, of course, is broken, my worry there is that it's not so much LOLR, but how would any bank would make money if they're going to hold 100% reserves, right? So it becomes like a warehousing function in that case, as opposed to intermediation function. So if you're going to intermediate as traditional banks do, you would have to go to a fractional reserve, right? And which is where the whole debate around the free banking and whether it was stable or not sort of revolves around, right? So the key challenge in the banking system based on a specie or any other currency reserve is that what is the prudent reserve ratio the bank must maintain. And of course, in the central banking system, we have mandate from the central bank about what should be maintained, right? And there are other requirements that come from the international banking systems. But in an open banking system, there is no mandate of any kind. So it's largely a commercial or economic decision about what percentage of assets you should hold in reserves, right? And if you are in that case, we have to ask what kind of system would then provide the stability that we want to expect. Right? My sense is that the free banking history has gotten a very bad deal, because most of the historians who wrote about it until recently, right, thought about it, focused on few extreme examples. The so-called wildcat banking, there are only few banks which entered in that kind of behavior. And that behavior was, of course, very immediately corrected by a clearinghouse system that began to come up. Right? It reminds me of somebody writing the history of, say, last 30, 40 years. Right? And something that we are reading 100 years later. And the history focuses on cyber attacks, spam, fraud, right? Nigerian bankers who are cheating people. So it's you look at what is being highlighted in the history are all the things which are out of normal. Right? Now, people who are living through the time, us, yes, cyber frauds are happening, all of those things, cyber attacks are happening, right? But that's not really the large part of the experience. Right? And that's exactly what has happened with the free banking system. The few examples of sort of bad banks are treated as the full history, right? Total history of the free banking system. And I think if you look at the recent research and scholarship on this issue, gives a very different picture of how the system worked. I think it's important for us to understand that history and get that right to some extent, to see how this new convertible currency, stable coins, can be regulated and what kind of role they can play.
Marco, do you have any thoughts and responses to that before we open it up to the audience for questions?
Yes, just one more thing related to what you were questioning, how to make sure that reserves exist. Well, one mechanism is the one of supervision, both on the side of central banks with institutions like entities such as the European Systemic Risk Board or the Financial Stability Oversight Committee, whether we assume that all these global stablecoin arrangements are systemically important financial institutions. But then on the other side, there is the importance of making sure that these entities are not defrauding the markets. And here is where the SEC and all the securities agencies come into play, protecting investors and also assessing the corporate governance mechanisms that are in place when deciding how to invest these reserves. Because one of the main problems also with money market funds is that they were breaking the back because we didn't know how the managers were investing the reserves and in assets that were not that illiquid. So there's a problem of existence of the reserves and the problem of managing these reserves. That is a problem of corporate governance and corporate governance accountability that these stablecoins arrangements should have. And one of the main problems with the first version of the Libra and again with Diem is that all these mechanisms of accountability are not that clear. So again, here I see the two coins, the two sides of the coin, with central banks involved in the supervision, but also securities agencies doing all the complementary controls that are inherently related to the distribution of these digital tokens, of whatever these stablecoin arrangements are distributing to the public. And this is probably the only way to make sure that together with the market practice in place, there is also a strong regulator that will bring much more certainty to the system. Because after all, if you look at the shadow banking system, the problem was that there was no certainty of what they were doing, how they were regulated. So here, bringing more clarity, thinking about the mandate of central banks and securities agencies would certainly mitigate some of the risks that are clear.
Perfect. So thank you very much for those thoughts. I'd like to open it up to the audience, virtually as well as in the room. So if folks have questions, please raise your hands online. Or so Deep, you have a question?
Yeah, I just wanted some clarification operationally. So is it true that when I do a stablecoin transaction, there are latency issues? Say, for instance, if you use a Visa or a Western Union, it will possibly take me a couple of minutes to a few seconds, but there is a wide variance in closure of the transaction using stablecoins, which may be a few minutes to an hour. That's my first question. Second is, is the energy consumption of transaction using DLT format, is it significantly higher than a normal card-based transaction? So are the actual operational energy consumption in DLT format transactions of stablecoin, are they higher than normal? So is it green? So these are the two questions I have for the panelists.
Panelists?
My sense is that comparing costs at this point in time, when this is an evolving and emerging system, would be quite unfair, right? Just like I think in most of the other tech businesses, the initial investments are much higher, and it takes time and further evolution for the system to be able to deliver value. So I would not want to compare the cost of whether what Bhargavi is pointing out, a central bank transaction of $5 versus $6 to $66 of stable coin at this point in time, because the system is really just getting off the ground. And what we are discussing here is sort of a highlight of that there is so much uncertainty, right? Not just among the stablecoin issuers, how they are going to be treated and what facilities and access they would have to the regular system, but also among the participants and customers on the other side. So I think it will be too premature to sort of begin to assess stablecoin on the basis of cost parameters. I think it should be assessed more in terms of where the system can evolve, and is it possible to have that evolution happen in a sort of gradual manner, in a safe manner that allows those values to then be discovered as the process goes forward.
My question was slightly different. It was more on the not exactly on the exact cost, which I'm sure would come down. It is on the time it takes. There's a more certainty if I'm using a credit card or any other format. There's a certainty of a certain seconds or maybe a few minutes. When I'm using the distributed ledger, there's a latency issue that sometimes I will know that my transaction has successfully closed in a few minutes. And sometimes if there is an overload in the system, it can take us few hours. So if I'm transferring a Bitcoin to you, on luckier days, I will get a confirmation that it has reached you in a few minutes. In bad days, when the system is overloaded, it may take a few hours. So I'm asking, is it the same with stable coins?
I have not transacted stable
okay,
coins.
No.
I can speak to that if you like. I mean, the standard billing that stable coins are offering is that the settlement is very fast, in seconds, if not quicker. So for cryptocurrency exchanges that are transacting in stablecoin, the reason they're using stablecoins rather than currency, particularly for cross-border transactions, is because a stablecoin is offering transactions that happen far quicker than you would in the context of international payments. So the short answer to your question, Deep, is that the reputable stablecoins like Circle, for example, Paxos and others, they are promising, and why they're being used in cryptocurrency exchanges, they are offering very fast settlement in how their internal validation system is working.
Thank you.
If I can add a point to Professor Yadav, we had a presentation last week from Strike's out of Chicago, and the typical time is a few seconds, as you mentioned, but even for the few seconds, you're guaranteed a price which you agree to, and this is all done in 5 to 10 seconds. But even that 5 to 10 seconds, there is some cushion. They have investors who will pick up any price change. But if you think of the volume, and you think of a normal distribution, this is really a wash. And so the key point is the speed. It has become so instantaneous that risk over thousands of transactions pretty much comes down to zero. It's the speed.
Thanks a lot.
So, Dr. Chitra? Vikas? Dr. Vikas?
Yeah. Good morning. I enjoyed the discussion, very interesting and quite new in many respects to me. I have been just beginning to follow this area. But stablecoin is a good idea, but I see that its growth has been very slow compared to other coins. Now, is there any particular reason why stablecoin has not grown to that extent as one would expect in the area of, generally risk-averse area? One would expect stablecoins to grow much faster. Well, why have they not grown? And secondly, providing insurance for these stable coins, will that be within the digital system, or will that require an outside agency to provide that insurance?
So Marco, I feel like you want to answer this question. So
I don't know if I really understood the first part of the question regarding the growth of stable coins. Are you, Dr. Vick, is comparing this, for example, to traditional cryptocurrencies? So what's really the sense of the question? Because if we compare the growth of stable coins in relation to the first wave,
that Bitcoin and so on.
Sorry?
Bitcoin and other coins compared to other coins.
I mean, I think it's really hard to compare these two entities, because basically many cryptocurrencies could have been compared, even if they were commodities, to the securities market. And so they were subject to the explosion of the securities market. And that's why in the timing between 2017 and 2018, we had a boom of ICOs that then triggered a significant growth of traditional cryptocurrencies. But then here, talking about stable coins, we are considering a rather different phenomenon that depends also on
that's okay.
That depends on an infrastructural growth that is much slower, and it requires more maturity, and that's maybe the reason why stable coins were growing at a slower pace. But this is, I am not sure that anyways this would be true if we look at the market capitalization of stablecoins. So there's a problem of perception of the markets, saying that traditional cryptocurrencies that are not, traditional cryptocurrencies, full stop, grow exponentially, and stablecoins didn't. But in the end, if we look at more objective data, probably is the contrary, with stablecoins also promising to attract much more capitalization compared to traditional cryptocurrencies. And then on the question on insurance for stablecoins, well, somehow this refers to the relationship that these private central banking arrangements, private shadow banking arrangements have with public central bankings. And I could see different scenarios, such as this shadow central banking fully replacing the current central banking system that is absolutely unlikely to happen in a way, or other more intermediate stages. And this would certainly affect the way we look at the insurance for stable coins in in a situation where there is a public and private entity involved in the central banking functions, then it would be much more likely that a central bank would act as an insurer for private stablecoins. And whether this would happen on a fully digital basis or on another basis, this is probably hard to say at the moment.
Yesha, we have a comment/question from the floor.
Yes, I was going to ask exactly that question, if there's someone from the floor.
Hi, this is Arvind Chari. I had two, one is a doubt, one is a question. If I compare stable coins with a tier 1 central bank digital currency, is there a comparison, or I don't understand that point well? And my second is a question to Bhargavi. If you look at the payment bank licenses, do you think there is a scope for a stable coin or cryptocurrency related payment bank solution out of India?
I think Manmohan might want to take the CBDC versus stablecoin comparison. I think he has views on that.
Yes.
And I'll take the second one.
Okay, I think I made this point in my presentation, and I would again reiterate, try to read those two speeches, which cannot be more different, Mark Carney and Randy Quarles. So to answer your questions, if the stable coins are in the reg perimeter, and if they are backed by reserves, yes, they are, I would say, almost identical to CBDC. If they are what they are today, like tethers and outside the reg perimeter, even if you have 100% treasuries, if a March 2020 happened, they are not stable. If you want the word stable, you need to bring them into the reg perimeter and give them reserves in a T0 settlement. This is not T22nd settlement. This is T0. That's why there are applicants who want to be inside the reg perimeter and want access to payment rails, and the whole discussion which we have had so far. Otherwise, yes, CBDC has advantages, but CBDC has other disadvantages, like how do you get back the deposits back to the banks? Central bank balance sheets are in trillions. Do you want to make them more trillions? Anyway, I think I answered the question.
So just on the second point on payment bank licenses, I think, yeah, I think that model is very similar, which is that you don't really lend out the money, right? You just take deposits and you keep it as in money market mutual funds or the absolute liquid instruments. So yes, you're right. I mean, maybe that's a model that, but I think the purpose of payment banks was very, very different from what we're trying to do with stable coins, right? Which is to reduce the costs of payments eventually. But I don't know if payment banks in the current form that they are, which is to give access to the most underserved segment of the economy. I'm not sure if they are the people who would really, it would require very, very different sort of, I guess, positioning, you know, for the lack of a better term. But yes, that would be a very similar idea. Yeah, it's not really fractional reserve banking at all.
Susan, how are we doing for time? I believe we are exactly at time. Is that right?
Yes, exactly.
Oh, wow. Okay, so time flies when you're having fun, when coins are stable, and we are learning so much from our terrific panelists. So I'd like to extend a special thanks to Marco and Manmohan for staying up extremely late, way past their bedtimes. Marco, it's 5:30 in the morning, and Manmohan, it's past your bedtime, even though it's only 11:30 at night. Anyway, thank you so much to the panelists. Thank you so much to Parth. Thank you so much to Bhargavi for an incredibly insightful and substantive discussion today. And back to you, Susan. Thank you so much for this terrific panel, and thank you for having this conversation.
Thank you.
Yesha, every December,
Thank you, Yesha.
Every December, we are thankful that we partner with you, and I'm thankful once again. Marco, Manmohan, thank you so much, especially Marco, who's probably in the twilight zone of the human being's sleep cycle. Thank you so much for having taken the time. It was it's a new field for all of us, or it's a new area, especially for me. I think that there's so much technicality involved in this conversation that I would have probably liked to have just understood a little more about the financial market stability angle. And perhaps it goes back to Parth's point about let's look at the history and bring in to see what the previous experiences has been in terms of truly what happened in terms of affecting financial market stability. I think of that as systemic risk issues, and I'm not yet seeing that in the world, right? So maybe we are just become an incredibly safe place. But thank you all very much. It's enlightening. And as always, great food for thought and new research ideas popping up all across the place. We are going to go into a break right now for 10 minutes, and we'll come back at 10:20 IST for the next paper panel. Thanks, Yesha. Awesome. Even though it was, tense as always, like it is with you, but great. Thank you so much. Bye.
Okay,
Talk to you on the-
sure.